Hello, everyone, and thank you for joining me, Dani Beit-Or, and my guest today, Scott Saunders, as we discussed yet another really, I want to say exciting, for me, it's exciting topic that it's related to real estate. As you know, when I speak to you, my active clients, my potential clients, many times we talk about the future, meaning once we accumulated wealth through an equity through real estate, what do we do with it, or how can we navigate this at the later stage of our ownership or investment or the cycle of the property? And 1031 exchange is amazing tool that you're probably familiar with. I know Scott will kind of touch on that a bit, but I reached out to Scott because I know I help a lot of my clients do 1031 exchange. I mean, there's almost an exchange going on in our end on a regular basis. But I wanted to reach out to Scott with a very specific situation. And I asked him not to talk about general 1031 exchange for the focus of this presentation, but more to focus on a very specific situation where many of you suffer. And when I say suffer, I don't really mean suffer and benefit or can benefit. And it's the combination of owning your primary residence with a lot of wealth or a lot of equity built into it. And how do you navigate that equity and wealth, out of that primary residence it's a sooner or a later point in your life, and really benefit from the tax deferring, not tax avoiding, tax deferring mechanism. And Scott was very gracious to kind of walk me through the details. And I said, listen, I get it. I'm here. I know the details of 1031 exchange. I get what you're saying. We really need to educate our clients more about this topic. So, Scott, first of all, thank you on a Friday morning joining me for this, I think, critical session for a lot of people who really want to navigate their equity and wealth. And I'm going to let you introduce yourself and then lead through to the topic of the 1031 exchange, specifically the combination of this primary and house, and how do you exchange that. And I may kind of jump in with questions towards the end or as you speak through. So Scott, please take the lead and then show me the way.
Hey, Danny, great to be with you and talk about this. So, we're going to talk about what you see on the title slide there, how to combine 1031 exchanges with the primary residence rules. And I'm going to go through a few different scenarios. And the goal today is to share with your audience strategies that they may not have heard of that really unlock powerful ways to harness all that equity that people have in primary residences. And at the very end, I'm going to walk through an example, show you kind of step by step of kind of a fictitious couple that bought a property years ago, appreciate it a lot, and what can be done. So I'm excited to jump into it. At the end, I'll just go quickly through the basics of 1031. But what we're going to talk about today is focused on primary residences and some different rules and how to do that. Now, I've been in the exchange space here since 1988. I'm a senior vice president with asset preservation. I won't list everything, but I've been doing this. I've 36 years in the 1031 business, and as probably most of your audience knows, in a taxable sale, we sell property, get back cash. In a 1031 exchange, we get back like-kind property. So it's property for property. 1031's been in the code since 1921, a long, long time, Danny. So it's a powerful strategy. And here's what it allows. Let's look at the most important thing. If you look at all of the different taxes, there's not just one capital gain tax rate. There are 4 different taxes. So if you sell any property held for investment, you could pay depreciation recapture at 25%, the remaining federal gain at 15 or 20. There's something called net investment income tax that affects a lot of higher earners that have significant gain. They're going to pay an additional 3.8% on net investment income over 200,000 for single filers, 250,000 married filing jointly. And then look at the state taxes. So the highest state tax in the country is in California, 14.4%. So at the end of the day, if you don't do a 1031, you're facing potentially all 4 of these taxes. Now, let's just dive into today's topic. This is so exciting. So 1031 is just tax deferral when you sell any property held for investment or used in a business and you reinvest in other like-kind property. So you're carrying the basis forward and you're deferring. Now, there's this part of the code, it's called Section 121. And I want to kind of keep this simple. 121 just means it's your primary residence, it's the home you live in. And as long as you live there 2 out of 5 years, you can exclude capital gain taxes up to 250,000 if you're single and 500,000 if you're married. So what's really powerful about Section 121 and why it's better than an exchange is it's tax exclusion, right? You get to put the money in your pocket tax free. And you can do that on a primary residence, essentially every 5 years or so. So powerful, powerful strategy. Now, here's what I want to get into. We've got the exchange, we've got the primary residence, so I've just covered those. I want to share 3 different scenarios. The first one is what we call a split treatment transaction, and we'll talk about that. I've got a home and I live in it, but I may rent out a portion of it. I may have a Airbnb on a room. Maybe I've got a detached garage and I got a little mother-in-law unit there that I rent out to college students or Airbnb. Maybe I've got a duplex and I live in one half and I rent out the other half to pay my mortgage. There are a lot of different ways to do this, and we're going to go through that. But this is a really interesting scenario, and I'll share with you, Dani. I helped a friend of mine about a year ago. I happen to be coming to you from Colorado. He's a home builder and had a home that went up in value, bought it, and had it for 20 years. But he ran his construction business out of his home. He had a home office. He stored his records there. His entire large garage had construction materials. And so he had a business use, was able to exchange out of the business portion, bought a property out of state free and clear that gave him retirement income, all from selling his primary residence. So really unpacking, is it all a residence, or maybe do you have some use of business or holding for investment on some of a primary residence? Then we're going to get into converting a rental that you do an exchange into and maybe convert it into your residence later on. Super popular strategy. And then finally, this is the icing on the cake. This is, Dani, where things are super exciting. We're going to talk about converting a residence that somebody bought many years ago for a low value, and it's gone up and it's now worth several $1,000,000. Converting that to an investment property and then combining the 2 different tax codes. So taking advantage of Section 121 tax exclusion, let's say they're married for $500,000, and doing a 1031 exchange. And what I'm going to show everybody in this last example is how to convert all of that equity that's accumulated from just equity that's sitting in the walls of your home into investment cash flow. So that's a really fun example. So let me kind of any questions you have, or you want me to kind of just dive
No,
into it,
no, I'm
Dani?
following. I'm already getting some questions here on the side, but I'm not
All
just,
right.
yeah,
So what we'll do, Dani, we'll take the questions, at the end, and I'll answer
sure,
everything.
no
So we've
problem.
already talked about primary residence. You live in it 2 out of 5 years, and this is what you can exclude. And let me kind of time date stamp it. We're doing this in December of 2024. There is a chance with tax laws being changed next year that these exclusion amounts may go up. I know there's some in Congress that would like to increase them to 1,000,000 and 500,000 from 250 and 500,000. So I can't say whether that'll happen or not, but these rules came about in 1997. I won't do a show of hands on here, but how many people know that property values have gone up a lot in America since 1997?
Yeah.
Everybody would agree. Property values have shot up. So this gives some exclusion, but the reality is it doesn't really help retirees that have one asset that's gone up a lot in value. If you're a single filer, a 250,000 gain over the last 20 some years really still leaves a lot exposed. So that's that rule. The thing I want to talk about now is a split treatment. And so when you do that, you're going to have to bring your tax advisor in to determine what percentage of the property is rented or used in a business versus lived in. If you have 2 bedrooms and a bathroom dedicated to Airbnb, then that square footage would be the investment portion, and the remainder would be your primary residence. But pull in a good tax advisor or CPA. Let me give you a super easy example here on this next slide. Let's say you have a fourplex, a 4-unit building. You live in 1 unit, you rent out 3. Very easily, about 25% of this would be the 121, the primary residence, and then you can do an exchange on the other 3 units. So simplistically, 25% residence, 75% rental. Now, here's something, Dani, that happens. A lot of people fix up their primary residence. If I have an old fourplex from the 70s, I've probably gone in and put in new cabinets and new flooring, and I've upgraded my countertops and my appliances. So it's not uncommon for somebody maybe to upgrade the home they live in because they want it nicer for personal use. So maybe more than 25% of the value is in the primary residence. Maybe it's 30% or 32 or 33. So get with your CPA and tax advisor, and they'll analyze what you have and they'll come up with a valuation based upon how they've been treated on tax return. But this is an example of combining both tax code sections. Very, very beneficial. Now, here's another example. You got a farm or a ranch. So here's a vineyard, 4.6 million in value. The dirt's worth 4 million, and you've got a really modest farmhouse in rural America worth 600,000. Again, you exclude the 600,000 and you can do an exchange on the $4 million of land. Here's an Airbnb, $1 million home. A room and a bathroom are Airbnb, 200,000. The residence is 800,000. So I'm just giving you some different examples to consider. Obviously, everybody's situation is different. Here's a home, 750,000 with a basement used for business. So that 250,000 is 1031. The main level and the upper level would then qualify for 121 as a primary residence. So just a few examples. Everybody's going to have a unique situation. Now let's go to the next one. We do a 1031 exchange into a new residence that's initially held for investment. And then later on, somebody decides to move into it and make it their residence. This is 100% permitted. You just need to make sure that at the time of the exchange, the intent is to rent the property then, hold it for investment. And then later on, your circumstances change, and then you decide, okay, now I want to go ahead and live in that property. So the you get exclusion for 121 for the amount of time that you live in the property. So let me just walk through an example to kind of flush this out. Somebody does an exchange and they rent a property for 3 years. They move into it and then live there for 5 more. So the total ownership is 8 years, 3 years as a rental, 5 years as a residence. They're eligible for 5/8 of that 121 exclusion, either 250 single, 500,000 married, filing jointly. So the longer you live there as your home, the better that ratio gets. If you live there, rent it for 3 and live there for 10, right, then you'll get 10/13 of that exclusion. Any depreciation recapture taken during the rental period is not eligible for exclusion, but this is a great strategy. So we got the split treatment as one, converting a rental into a residence. And now let me shift gears and let me give you kind of the most powerful strategy. And I'll tell you what, a lot of real estate professionals don't know this, or not everybody's aware of it. And I'm not bagging on real estate professionals. They're good at selling real estate, but this is how do you use the tax code to get the best optimization for your asset. So let me walk through this one here. We have guidance that came out way back in 2005. The formal name is something called Revenue Procedure 2005-14. That sounds like a lot of gobbledygook. The CPAs will love it because it's a reference they can pull up to see exactly how to do this. But here's what it says in English. If I use something as a residence and as a rental and it meets both rules, then I can combine the 121 tax exclusion and I can take that even though it's a rental recently and do an exchange on the remaining equity. So this is a great strategy for investors in the San Francisco Bay Area, La Jolla, California, any market where property values were really low and then they've gone up over the last 20, 30, 40 years. These markets, and they're all over the country, a lot of places where values have appreciated a lot. This is a game-changing strategy. So let me just kind of walk through an example with you, Dani. I'm going to give you real life numbers and just show how powerful this is for the people watching this. Let's say we have a married couple and they bought a home in San Jose, California, 25 years ago, 300,000 bucks. Today, the home's worth 10 times what it was worth when they bought it. It went from 300 grand to $3 million. Not uncommon to see appreciation like that. So this taxpayer, they've lived in that home now for the last 25 years. They move out of it and they convert it into a rental. So they go rent, they live somewhere else, doesn't matter. And they rent out that property. And in my example here, for 18 months, it just has to be held for investment. It could be a year, could be 18 months, could be up to 2 years. Now, after the lease expires on month 18, they're going to go ahead and list the property and sell it. So they're selling a property that was their former residence and most recently a rental. Because they lived in it 2 out of the past 5 years, they're able to exclude $500,000 in gain. So $500,000 goes into their pocket tax-free, really big. Now, I'm going to show you what they do with it on this very next slide. And when you guys see the numbers, you're going to go, your eyes are going to pop out. Like, this is huge. Now, I'm going to share with you one thing. All right. So I'm a real estate investor and a 1031 expert. There are returns in markets outside of California that might have a little more cash flow. California is a wonderful appreciation market, but there are a lot of parts of the country that people might exchange into outside of California. So I'm going to bring up the example. Here's where we go. And there's a typo there. From the $3 million sales price, 500,000 is excluded, leaving $2.5 million. They do an exchange, and now they're going to purchase 12 rental houses in Memphis, Tennessee, and they're going to purchase them for 200, and I think it's 212,000. So just go with the numbers. In my head, it's right. Apologize on the slide. I didn't get them all cleaned up. Here's the scoop. Each one of those houses will kick off about $2,000 in rental income. They have 12 of them. 12 times 2 is $24,000 a month rental income coming in. That is a lot of money. We're talking just under $300,000 annually. So here's what they've done. They've got the benefit of the 121 exclusion, and $500,000 is tax excluded. They then now have converted all that equity that was in their home, they've converted it into investment properties to kick off retirement cash flow. So, Dani, here's the takeaway on this. There are people in markets with a lot of appreciation that have a lot of equity. Converting that residence into a rental and rent it out for, let's say, a year to 2, and then doing an exchange, now you're able to convert all of that equity that was in your residence into equity and investment property. And by the way, you're buying these properties now free and clear. You've got no mortgage on them, no debt service. Very, very conservative for people that want to retire and are looking for an exit strategy. They've now converted all of that gain and equity into cash flow. And guess what they get? They're still going to get depreciation on that. Now that it's a rental property, they can depreciate those rentals over 27 and a half years. And Dani, we could talk about the types of property. We could go into 12 rental homes in Memphis. You could buy one commercial property as well for $2.5 million, right? With a commercial tenant. So there are a lot of different ways. I recommend, and I'm not a tax advisor, but I'd recommend a little diversification. Maybe 12 rental homes is too much, but maybe picking up 2 or 3 properties in different markets gives some diversification and cash flow. So this is kind of the crux of the strategy that you wanted to flesh out today, Dani. This is a great way to combine both tax code sections. I think most of your clients know what a typical delayed exchange looks like. Close, you have day 0, 45 days to identify, a maximum of 180. We've got those time requirements that I just mentioned, different rules to identify. And then you just got to make sure the identification is done in writing. So like-kind property for everybody, very broad, residential, commercial, ranch, vacation home held for investment, all sorts of things there. And I'm going to kind of circle back, Dani, to you with questions that might be coming up as we're talking, or questions you have. I've got my contact information there. And by the way, our Our company asset preservation is based in California, and you'll see our national headquarters there, 800-282-1031. So, Danny, I'm going to kind of kick it back to you for questions,
Perfect.
anything you want to flush out, but I wanted to hit
Yes.
on that big strategy with you.
So first of all, very clear for me. It's very clear. Really flashing, flashing the point I wanted to make. I do wanna kind of confirm or check with you a couple of things just to make sure, and then maybe want to illustrate some tangible points regarding this strategy. So first of all, as you mentioned earlier, I'm just reconfirming this is a tax defer for both federal, state. So California, does okay, is okay with a 1031 exchange. Treat it, they accept the 1031 exchange plus the additional wealth tax, 3% to 3.8, and the recapturing, right? So we have four things that are, because some people think that California or some states do not recognize the federal 1031
Yeah.
exchange
Yeah.
treatment.
Yeah. So, Danny, you're 100% right. Any state in the country, it used to be Pennsylvania was one that didn't have this for state taxes. They modified that a few years ago. Every state in the country can, but let me share one unique anomaly with the state of California. So, this is important for your audience. When I'm in California and I choose to exchange out of California, I go to Texas, Tennessee, Florida, you name it, you're on the hook to file a tax form with the state of California every year. And this is called a clawback provision. If you sell that property you buy out of state 10 years from now, California is going to come knocking at your door and say, hey, guess what? You had all that gain in California. That was a benefit of living in our great state, and you got it. But now if you're not, if you're selling and getting the cash, we're now going to tax you on the gain that happened while you owned the property in California. So every year you have to file the form. But let me give everybody the flip side. As long as you keep holding for investment and keep exchanging, you don't have to pay your capital gain taxes ever. So you exchange and exchange and exchange. And then I got the ultimate tax shelter for you, right, Danny? You die.
Yeah.
You pass away, your heirs get a step up in basis to the fair market value at the time that you pass away. So you're not paying capital gain taxes. You deferred them, but you're not paying them. And guess what? Your heirs get all that appreciated real estate. They don't pay capital gain taxes either. So this is really a game-changing strategy for a lot
Yeah.
of people to know that you can use legitimate parts of the code. This is 100% defensible, bulletproof, very, very straightforward, happens all the time. Our company, Asset Preservation, we do hundreds of these exchanges, hundreds and hundreds and hundreds every month. We've done over 200,000 of them over 30 plus years. So
Perfect.
it's conservative. Yeah, to
Okay.
answer that.
Yes, I love that, and thanks for emphasizing those things. I think that there's a lot of sometimes misconceptions of the actual, and that's why I have you here. The other thing you mentioned, you in this example, you pointed out 18 months. So I'm converting my primary to an 18 months term of rental, and then I can start the exchange selling. So selling my used to be primary a year and a half ago rental for the past year and a half. And doing an exchange. I want to understand better this 18 months. How much time
Yeah.
are we talking? Like, what dictates
Yeah.
then this 18 or 12
Yeah.
months or 24 months? Or, hey, can I do it for 3 months?
Yeah. So, Danny, this is a question we get all the time. And I'm going to ask you, here's the question we get. How long do I have to have it rented? What's the time period?
Yeah.
That's the question. And I'm going to give you the answer. It's not the answer you're looking for. Here's the answer. You ready? There is no time period anywhere in the tax code. What matters is your intent to hold for investment. And really important, this is a key. What objective, provable facts do you have to support that your intent was holding for investment? So in the slideshow, I said 18 months. I made that up. It could be 12 months. It could be 18. It could be 24. To your point, you don't want to have it held for just a few months because that looks like you're not really holding it for investment. Most CPAs and attorneys, tax and legal advisors would say if you want to be conservative, at least have it over 12 months. and some would say maybe up to 2 years or more. So somewhere, if you want a time period between 12 months and 24, as long as you don't have any contradictory factors, that's fairly conservative. Now, if those of you that want to get really literal with me, that time period is not anywhere in the code. There's no requirement that it be 12
Right.
or a year and a day. I know of a tax court decision, Dani, in California, where somebody held it for 8 months, but they were able to prove that their intent was to hold for investment. Now, I won't get into the weeds on that tax court decision, but 8 months for most people is probably going to be pushing it. If you want to be conservative, somewhere between 12 to 24 months, as long as you don't have anything that contradicts that, that's going to be a reasonable time frame. But I would say this: talk to your tax advisor. I can't give you tax advice. I'm an expert on the 1031 rules. Dani, you're an expert on real estate, right? And so I can tell you what the 1031 rules allow and don't allow. And in this particular area, it all comes down to your intent and then what provable, objective facts you have that either support the investment intent or contradict it. And so keep that in mind. That's
Yeah.
really the bigger
Yeah.
issue. It's what you can prove about your intent. So in a perfect world, everybody would do a transaction that's conservative and very provable. Think of it this way, Dani. You got $3 million you're selling for. Why would you want to mess around over a few months with that
Absolutely.
much on the line? Just do a conservative exchange, well documented, establish your investment intent. And the term you hear is swan, sleep well at night, right? Then you don't have to
Love
worry
that.
about it. So
Yes.
swan it up.
Gotcha. I love that, and I think that's excellent. I actually wanna uh, make a note to our audience based on everything you've shared with us. This is an amazing strategy, but there are disadvantages here. The main disadvantage, you'll be surprised, is actually in order to really leverage it, in order to really benefit from it, you need to plan in advance, meaning you got to start thinking about what you're going to do with this house probably 2 to 3 years before, because the biggest inconvenience, and I've already had people, maybe two that I spoke to about it recently, when I told them you need to, if you want to maximize this benefit, this vehicle, 1031 exchange vehicle, you actually need to move out of your house somewhere else, right? Maybe buy or rent somewhere else for, let's just say, based on this, example, for 18 months. And I had two people like, but that's very inconvenient for us. And I'm like, yes, it is. But what's more inconvenience? $300,000 you're looking at taxes in that example that I had, 300,000 in taxes, not the gain, the taxes, or inconveniencing yourself, for a year and a half in order to save that, in order to not to pay that. And I think for me, the answer is very clear, because sometimes my next question to the client, to the people that I work with, and it can be even 100,000, not just 300,000. How long does it take you, right? If you're listening to this, not to earn 100,000, but to save and set it aside 100,000. It's a totally different answer. Like, you can be a huge earner, but by the time you save 100,000, not to mention 2 and 3, that can be more than 1 year, not to, and maybe multiple years. So think about it this way. And that's why you have to, the disadvantage, you have to think about it today in order to plan in the next 6 months to a year what you're going to do in order to position that primary as a rental, in order to finish those 18 months, in order to do an exchange. This is almost, if you're moving fast, it'll take you 2 years, right? If we're maybe optimizing, a year and a half to do all of that.
Yeah, I agree with your thing on the notice and the advance notice and planning. The other thing to keep in mind, you guys, everybody's tax situation is different, but if you're selling for 3 million and you bought it for 300 grand, you might have improved it a little bit. You're going to have roughly 2.7 million in gain. If I just use, and California's got the highest state taxes, just ballpark it, let's just say a third of that. You're talking $800,000 in
Gotcha.
taxes. So to Dani's point, for me to keep 800 grand, I got to make like $1.4 million to after tax keep 800,000, which
Yeah.
is the tax rates. And so the benefit of an exchange, and this is really important, it is not just the tax savings, right? You're saving 800 grand on taxes. It's the purchasing power those tax savings give you. So you
Absolutely.
guys, I gave a super simplistic one. It's a free and clear house. We take all the cash, we buy for 2.5 million. Let's say I go to Memphis, Tennessee, and I happen to know that market really well. And instead of me paying cash, I just buy homes with 50% down, 50% leverage. Now I'm buying $5 million of real estate.
Yep.
Now, let's just use my example of 24,000 and just assume I double it, just rough numbers. Now we're talking $48,000 of gross rental income. You'd have to back off the mortgage payment, but we're talking that's a lot of money.
That's a lot of money.
Most people could retire on that amount of money times 12. It's huge. So
Amazing.
adding leverage is like supercharging your car, right? A
Absolutely.
four-cylinder car gets you from point A to point B. Awesome. A four-cylinder with turbocharging, a lot of the new cars, what does it do? You got more torque, more power. So adding leverage is like adding a turbocharger to your engine. And we could go through all sorts of what if scenarios. This is a powerful strategy. And my numbers that are there on the screen, give us a call, check out our website. We want to be a resource. I'm a pro on 1031s, and our headquarters out in California. We're just outside of Roseville, in Roseville, actually, outside of Sacramento. Call us anytime. That's what we spend all our time doing, is just
Perfect.
talking through scenarios. So feel free to pick our brains. That's what we're we're here to help you out.
Scott, I want to thank you. That was very clear to understand, to follow. Great example. I think it's very relevant to a lot of the people we work with. I've already started talking to some of them. There, some of the reaction was, "Wow, this is amazing." I mean, I think they knew of the idea of 1031 exchange, but never brought it home. Literally, never brought it home. Right. I really appreciate this super valuable, so doable, right? Requires planning, but so doable strategy. So, and thank you for sharing that with us. For you guys, a lot of you are in that situation. If you're still a little bit lost about it, either reach out to Scott. You can reach out to me. I am not as experienced as Scott in 1031 exchanges, but we have clients who've done many of them, right? So we can definitely help you plan for the exchange, strategize the exchange, uh, optimize. We have our own kind of methodology how to just work with the exchange limitations, but just find ways how to optimize it. When you're trying to identify the properties, the 45 days seems a lot, but actually it can be a very short period of time for a large exchange. So we've done that a lot. Scott, thank you very much once again for the information. I really appreciate it. Have a terrific rest of your day and have a great weekend, everyone.
Thanks, Danny.